This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
So a question mark around where we are economically speaking continues to linger because there are so many different headlines that give us conflicting messages. The market continues to do well, but inflation is high, and what's the Fed doing, et cetera, et cetera. And Moody's Analytics has been tracking the economy for more than 80 years. They say when a certain number in their model hits 50%, that a recession follows. And apparently, Abe, they've never been wrong. And recently, they moved those odds up to 49% of this model that historically has predicted a recession. So for somebody who is near retirement and they are concerned about what happens if the economy, if the market crashes, there's this issue, sequence of returns risk, which we have discussed here before on the radio. Let's discuss that again. Let's explain what sequence of returns risk is and what preventatively retirees and pre-retirees can do about it.
Yeah, you know, those recession stats, I mean, you just never know, right? And those things happen when you're in the market for a long period of time and you're just alive, right? There's going to be ups and downs. And I don't think we need to be scared by these headlines, especially when you have a plan that is built to weather the ups and downs. And I think that's the key.
Okay.
Is that the closer and closer you get to retirement, or if you're in retirement, you know, most of the people that we meet with, so many of the people we meet with, so many of our clients have what I say, they've won the game. That's what we say a lot here, right? You've won the game, Heather. And if you've won the game, which means you have more than enough money than you'll probably ever go through in your lifetime, why then take on any extra risk to accomplish your goals and objectives? It just doesn't make sense for a lot of people to continue to take on more risk if you've hit your number and you've got a number big enough for you or sufficient enough for you to accomplish what you want to accomplish. Then why? For what purpose? So being aware of, you know, things going on in the economy and the markets is definitely very important. And having pieces of the portfolio that are absolutely buttoned up, protected from big volatility, especially pieces of the portfolio you can dip into when the storm is bad, is key, especially in the first 5 to 10 years of retirement when you're withdrawing money out of your life savings versus putting it in. So Heather, you asked about sequence of returns risk and what that risk is exactly. And it means really the order of market gains and losses in retirement, right? Sequence of returns. Here's how I kind of define it.
Okay.
Is the risk to any retiree in the withdrawal phase of retirement, the distribution phase, not the accumulation phase. Okay. It only pertains and matters when you're pulling money out of your accounts. That when the markets are down, if you don't have a safe place to go to and you're selling stocks or funds or investments while those positions and funds are down, you've got the losses in the market and your withdrawal on top. You've got two losses. Okay. So you can avoid or eliminate sequence risk by diversifying and having pieces of your portfolio that are protected from any loss. And so losses early on in retirement can do devastating damage because retirees are withdrawing money while markets are down, shrinking the portfolio faster than it can recover. And you may say, if you're listening right now, you may say, well, Abe, the markets come back. The markets always come back. And yes, I believe that too. And over a long period of time, the markets usually win. But you know what? If you're losing money and the markets are down and then you're taking money out at the same time, it makes the hole that much deeper and that much harder to recover from those losses, right? It's not like, you know, if you're in that position and you don't have protected monies, it's not like you can say, I'm just going to stop pulling money out next year. You probably still want to live the retirement you want to live, right? So having a plan to protect against market volatility, having a plan to avoid or eliminate sequence risk, timing, all of that really, really matters. So retirees, what can retirees do about it? Retirees approaching or entering retirement may want to adjust their portfolio allocation and withdrawal planning to limit the impact of retiring into a down market and reducing the need to sell investments during market declines. Again, that first 5 to 10 years of retirement being absolutely crucial to get through without devastating loss. We just recently worked with a couple out of Culpeper, Virginia, about $1.5 million saved, 7 risk on our risk scale, 70-30 allocation, 70% of the assets, you know, they wanted set aside for long-term growth, 30% of the assets they want to set aside for safety, for income, for protection, and so forth. Came to us with no plan. Essentially, almost all the money was in the TSP. They also had some IRAs as well. And in the TSP, they had almost all the money in the C and the S funds, which are two of the biggest growth funds in the TSP.
Okay.
came to us wanting income, right? As so many people do. It's like, Heather, I'm 60, I'm 62. I got $1.5 million. Kind of want to start taking Social Security now. I'm not working anymore. I've turned on my pension. And Abe, I also got this $1.5 million sitting here in the TSP and feel like I got a good, pretty good penny in there, and I want to enjoy it now. And you know what this couple told me? I want to spend down every last penny.
Good on ya. Do it.
Good on them. What does that mean?
Spend your money.
Legacy is not important to this couple, and that's okay. That's what you saved this money for.
Or maybe a different kind of legacy, though. Some people are like, we want to spend the money taking our kids and grandkids on these trips. We don't need to leave them a small fortune. And that's very
such a good point.
Important legacy.
It's a different legacy, and everyone's needs and goals and objectives are different in retirement, and the way people want to spend their money is up to them and how they want to do that. So when our clients tell us, hey, this is what I want to do, I want to spend it all down, we're going to create an income plan to help them achieve their objectives, which means an income-focused retirement plan, right? So this is why this gentleman and his wife came in and they said, you know what, we've got the growth bucket here. We've got $1.5 million saved. Show us how to put together a plan. Show us how we can enjoy this money and get after it. Get out there and travel and enjoy it. So we put together a retirement income plan, a comprehensive retirement income plan. I mention this on the show all the time, but that's really the first thing we do with the client or prospective client is show them, hey, Heather, here's all your stuff. We can put it together in this plan. This is what it's going to look like, and here's the income you can generate from all your money you've accumulated the last 30 to 40 years. We diversified the assets to serve different purposes. Again, some set aside for growth, some for income, some of those income assets to avoid sequence of returns risk. So there would be a safe bucket to pull from, especially in that first 5 to 10 years of retirement. If you're 55 years old and older, you've saved $500,000 or more for your retirement in investable assets that we can help you to manage. We want to help you put together your own customized and comprehensive retirement income plan. Get that roadmap. Get that GPS for your retirement. Learn how to take your savings and create enjoyable and dependable income. Complimentary.
All right, let's talk tech. As a proud Virginia Tech alumni, technology is deeply embedded in my blood. We live in 2026. I remember back when I was starting college, I can't remember if it was my class or my sister's class. She was 2 years ahead of me. But it was like the biggest deal because I think it was her class was the first year of engineers where every engineer was required to have their own individual computer of their own in their dorm room. And then when I started, everybody in the business school, Pamplin School of Business was required to have their, and kids these days with their laptops, it was like such a big deal that everybody was required to have their own computer. Look at us now with our smartphones, Abe, and our all of our tech stock investments, the S&P 500 doing what it's doing.
Hey, back in my day, Heather, I had to go to a computer lab. There were no laptops and things. It's like you had to go in, you had to schedule a time to go into the computer lab, fire up this thing that felt like it was from the early 1900s.
Remember the size of the monitors? The monitors were 2 feet deep.
Mm-hmm. Yeah.
It's a better time, simpler time. Some might say it's a more complicated time, depending on how you look at it. And technology, undoubtedly, as you know, listening to us on the radio, it touches every part of our lives, even our investing, from trading platforms to algorithms to AI-driven tools. But New York Stock Exchange President Lynn Martin was saying to Fox Business, the human element still matters. This is Lynn Martin.
We've got the state-of-the-art technology, which processes more than 1.2 trillion messages a day. But importantly, we have those 3 layers of defense on top of it, which is the human judgment. The humans can step in when things start to look a bit off, when there's additional volatility in the market. And the humans here do that every single day.
The human element, especially when it comes to our money. And we talked before about don't be emotional about your money, but you can't say that to people, Abe. It's their life savings after all. And being able to connect with somebody when things get rocky, not just financially, but with so many different things that can go awry in our retirement. So thinking about the New York Stock Exchange, it still needs people to step in when something feels off. What does that say about investor behaviors, the folks that you work with, Abe, trying to make big financial decisions on their own?
So many decisions that have to be made at the point of retirement, Heather, that are not just investment related, what funds I need to choose and things like that. It's all of these other questions around the money that we're faced with at this point in life, like Social Security, living longer, taxes, healthcare, all these things. Sometimes it's, hey, my spouse is getting sick and we're going to need to put a ramp, on the house. We're going to need to move things around in the house. We're going to need to put a bedroom on the first floor to accommodate this family member that's kind of going downhill with their health. And you need that human interaction and conversation with someone who's done this. I've been in this business now for 23 years, and I feel like I've seen a lot. Maybe I haven't seen it all, but I've seen a lot, and especially these things that require human interaction and experience when it comes to advice in these situations. But yeah, you've got the risk of living longer, and so there's all kinds of decisions about creating sustainable income, making sure that income is there for you in your later years. Healthcare costs, market downturns can have a lasting impact when there's no paycheck to replace the savings. Taxes can be a huge drain on your retirement dollars that you've saved. And some costs are easy to underestimate. In fact, one of the biggest mistakes do-it-yourself retirees make is assuming Medicare will cover most of their healthcare needs when that's not the case. Retirees can face significant healthcare and long-term care expenses that need to be accounted for long before they arrive. In fact, one of the biggest reasons why a lot of our clients come to us when they're in the meetings and they're talking about the need for long-term care or health care planning and things like that is because they've experienced a family member, a parent, an aunt or uncle that has gone into a nursing home or whatever it is, and they understand from a real life situation and perspective how costly it is and how draining it is emotionally and how important it is to have a plan for those things. So if we're acting with emotions when we're making financial decisions and all these decisions around our money, that can lead to costly decisions. So retirement mistakes are behavioral rather than mathematical. Having an objective person challenge assumptions and provide their perspective can help investors avoid decisions driven by fear, uncertainty, or overconfidence. And that's one of many reasons why hiring an advisor, a retirement planner, I would say, who specializes in helping people 55 and older can be so important. We just recently met with a family who's got about $2 million saved, early to mid-60s, live in Northern Virginia. One of the spouses has some health challenges, and that was their biggest kind of motivation to come in and set up a plan, Heather, is, hey, I want my wife, want my kids to be set up. Health is kind of going downhill for the husband, and just kind of being realistic about it. It's a pretty bad diagnosis.
Okay.
Wanting to get out in front of this as much as possible financially to put together a plan that is really can be seamless for the wife and the kids, right? So that when that day comes, the plan is set up and the wife and the kids know exactly where to go to take over from there. So that was the motivation for this family coming in to meet with us. And we see that actually a good bit, right? As we're aging, sometimes one spouse is doing better than the other health-wise, and that's a big motivation and compelling reason actually to come in and get everything in order, getting that financial house in order, to include things like the estate plan, right? So important.
Yeah.
So we put together a comprehensive retirement plan, of course, personalized with that human touch that you can't otherwise get through AI, through tech, through ChatGPT, through some type of model out there in the internet. You can typically only get that from meeting with someone face-to-face, maybe over video or whatever. So if you're 55 years old and older, you save $500,000 or more for your retirement and investable assets that we can help you to manage. We want to help you put together your own customized, comprehensive retirement roadmap. Put everything together into one plan under one roof. Make sure your loved ones are taken care of. Get that plan on autopilot, because that's what you deserve. That's what you need in retirement. Complimentary.
Abe, another headline I wanted to ask you about was this information that came out of Fidelity. For the first time in a year, Fidelity says the number of 401k millionaires slipped down 3% early this year, yet fewer than 6% of investors made any changes during the volatility we saw earlier. So for somebody who has built a sizable portfolio, is the stay the course mentality always the right move, or is market turbulence a reason to get more intentional, particularly for folks that you work with? They are near retirement, they are in retirement. What's the takeaway for adjustment?
I think that's a great question. It's something to really think about. I think staying the course could be right for you depending on where you are in life, right? Let's say you already have a plan set up. You already have assets set aside for market volatility. You have safer assets set aside for market volatility that you can dip into and not maybe sell positions, right? You've got a plan set up. So maybe you could stay the course, right? Maybe your desired allocation is a 60-40 or 65-35, and the markets have done well, so you've ticked up a little bit towards the market side. Maybe we talk about that and you say, you know what, I can handle a little bit more risk. I'm fine right now. I've got pension coming in, Social Security coming in. But on the other hand, market turbulence, is that a reason to get more intentional about doing something? It could be. I think the bigger thing and the bigger reason to get more intentional is where you are in life. And like, are you at the point of retirement? Are you 5 years or less away from retiring? Are you retired? And do you have the amount of money you need to last you the next 20 to 30 years? So many people that we meet with, Heather, they're in a great position. In fact, most of the people that we meet with are. The ball's in their court. You're at retirement. You work 40 years to get to this point. You work 30, 40, maybe 50 years to get to the point where you can pull the trigger and retire on your terms. That's what you want. That's the reason why I think people should start to change the planning and the models and everything about their plan from a mindset that's purely focused on growth and return to a mindset and a plan that's focused more on income, growth and income and protection. Maybe preservation if you want to preserve the money for the long haul and pass money on too. And then build a plan around all the decisions you have to make in your 60s that you never had to make 5, 10, 15 years ago. Social Security decisions, maybe tax decisions, Medicare decisions, long-term care decisions, estate planning decisions, all these things that didn't even matter too much, right, when you were 40 and 50. We just recently worked with a couple here in the Northern Virginia area as well, $6 million accumulated, wonderful job of saving. But the reason they came to us is because, and we see this oftentimes, is that the husband was running really with most of the financial decisions, wanting to now include the wife more, wanting the two of them to be more on the same page. Yeah. That way, if anything happens to him, she's taken care of. But they've done a wonderful job. I would say he's done a wonderful job. And the financial advisors and brokers that he had worked with in the past had done a good job for him too in terms of growing the money. Okay. He got to $6 million, but he's realizing, you know what? I've hit my number and I don't want to blow it. I don't want to mess it up. Right. And why take on a big loss right as we're retiring when I don't have to? Now, that doesn't mean he's going to move all the money to the sideline and just put it all in cash. I mean, that would probably be pretty silly for most people. Right. But I think it's a time to really, really understand, really have a good idea of what you have in the phase of life you're in, and just ask yourself, should I continue to be invested the way I am right now? Or maybe should I throttle it back some? Should I take on more risk? Am I too conservative? That's an exercise I feel like everybody should go through at the point of retirement, and that can be done through a portfolio X-ray and analysis. So they came to us with stuff everywhere, multiple advisors they were using, multiple brokers that were buying and selling things for him, kind of like a lot of people did back in the day, wanting consolidation and wanting a plan that could help them turn and go from what we call phase 1 to phase 2, or let's call it from growth to income. We put together a portfolio X-ray and analysis for them, which helped them to understand where they are today. And we show them how we could put together a plan for them according to their wishes. And that was better designed for what we call phase 2, the retirement descent. If you're 55 years old and older, you save $500,000 or more for your retirement in investable assets that we can help you to manage. We want to help you put together your own customized portfolio X-ray and analysis. Learn what you have invested in today, right? You might have multiple accounts out there. Understand the pros and cons. Understand the risks, costs, fees, highs and lows, so you can make the best decisions going forward as you head into retirement. Complimentary.
Abe and his team, they're here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abish Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m. and 5 p.m.
Abish Financial Wealth Management is an SEC registered investment advisor. Registration does not imply a certain level of skill or training, and the SEC has not approved or verified this communication. As a registered investment advisor, we are a fiduciary under federal law and owe our clients duties of care and loyalty. Abish only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. This material is for general informational and educational purposes only and is not individualized investment, legal, or tax advice. Investment advice is provided only after engagement under an appropriate advisory agreement. Structured notes, annuities, Roth conversions, and related strategies involve risks and may not be suitable for all investors. Structured notes may involve issuer credit risk, limited liquidity, capped or conditional returns, loss of principal, and protection features that may not apply in all market conditions. Annuity guarantees depend on the financial strength and claims-paying ability of the issuing insurer and may be subject to caps, restrictions, fees, and surrender charges. Roth conversions are taxable events, and outcomes depend on individual circumstances, future tax rates, and investment performance. Third-party rankings or recognition are not guarantees of future results, endorsements, or representative of any client's experience. Criteria and fee information are available upon request. Any hypothetical or illustrative scenarios referenced in marketing materials are for demonstration purposes only, do not represent actual client experiences or guaranteed outcomes, and should not be relied upon as predictions of future performance. Investors should review all offering documents, understand applicable risks, and consult qualified financial, tax, and legal professionals before acting. Past performance does not guarantee future results. Endorser is not a client, and this testimonial has been compensated. Opinions are their own. Compensation may create a conflict of interest. Testimonials may not be representative and are not a guarantee of future results.